Testing 1, 2, 3. Getting started in 1 minute. Welcome to Business Mastery Wednesday. Glad to have you today. All right. Great to see everybody today. Welcome to Business Mastery Live Wednesday. This is me, Cheston Bolgen, coming to you from By the Books Consulting. We're going to go ahead and get started with this conversation today. Today, we're going to talk some more financial terms. Last week was a really great conversation with Idris Talib. Talked about entrepreneurship. And man, those conversations I could have all day, because it really does take something to do what you and I do as a business owner, right? It takes really going inside and uprooting a whole lot of things in life that don't work and don't serve, so that we can come out here and produce the results that we intend for our lives and make a difference in the world with whatever it is that we're doing. And if you're in this conversation, I know that's what you're looking to do, okay? But without further ado, we're going to go ahead and get started with this. Like I said, this is me, Cheston Bolgen. This is how you reach me. You can come to our website at bythebookconsultants.com, 888-4BTB now. This is my email address, cheston@bythebooksconsultants.com. Okay. You can also reach us at youraccountingsuperhero.com. Quick disclaimer before we get started. The following is for educational purposes only and is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and or legal professional for specific advice. Of course, we always want to take your feedback. If you ever want to drop a line in here and say, okay, I want to talk about this, Cheston. I'm really working on this thing in my business. I don't know, what it is that I need to do to get beyond where I am. I know it's a matter of being more efficient, or just like something that I need to execute on, and I just don't know what that is. Whatever common issues that you may come across in the day-to-day, I definitely want to make sure you have access to solutions through being a part of this webinar. Okay. So definitely, this is how you reach me on either on IG at Your Accounting Superhero, or on LinkedIn at Your Accounting Superhero, or you can just email me. Let me know, like, what is it that you want to bring to this conversation, so that we can move life forward for you, move your business forward for you. And this is 10-figure business mastery. Ooh, man. Every time I say it, right, it might be intimidating for a lot of you. It's like, man, I'm just trying to, make that first million, right? Or consistently do that 6-figure mark, right, every single year in your business. Right? Some of you are there with that, right? And really, it's about removing restriction and limitation and shifting the reality of where you are, so that you can take your business to whatever levels you want to take it to, whatever that may be. It might not be 10 figures. It might just be, I want to have freedom and autonomy, so I'm not working in the business every single day and every single moment. What is that going to look like for you, and what are you going to have to do to create that, right? So really, inside this conversation, we're all about that. All right, it is for you. if you're watching this. It is to take your business to the next level if you're hearing this conversation. And it is possible. And what are the tenets that we stand on? Intentionality, which is mindset mastery. We have financial mastery, which is financial literacy, the conversation we're going to be talking about today. We have structures, which is system mastery. And then we have actions, which is execution mastery. We have all these things working together in harmony, and there's no option but success in what you do. Okay. So I invite you to consider that if there's any loss of traction in your business, is going to be in one of these fundamental principles that you are lacking. All right. So we're driving forward in 2023. It is almost halfway through a year. And this year is running by fast. How are you doing? How are you performing inside of your business? You want to take a look, and every moment that we have to sit here and reflect, we want to take that time to see, what has been really working for you this year. What has not been working for you this year. And then simply just take out those things that have not worked and start doing all the things that just work in your business. So today, we're shifting gears. We're getting into some financial literacy. And a lot of the times, if you're not a numbers person, it's okay. Even, I always say that numbers are the language of business. And even if you don't feel as though you're good with the numbers, there's nothing wrong about that. Everybody has the talent and the skill set to which they gravitate, right? You might be more creative inside of your business than really geared to understand and read the numbers of the business. And that's fine. The thing is, we also want to expand our base so that we have all the components necessary to run a successful operation. And no matter what situation you're in when it comes to business, right? And to do that, you want to understand some basic components of financial literacy. Cash flow is the main thing, okay? So there's a definition here for cash flow. It's a noun, the total amount of money being transferred in and out of a business, especially as affecting liquidity, from the Oxford Language Dictionary. I don't even know if you understand it better by reading that definition, right? Here we go. Let's look at Investopedia. The term cash flow refers to the net amount of cash and cash equivalents being transferred in and out of a company. Cash received represents inflow, while money spent represents outflow, which is more of a layman definition for cash flow. And still, we want to make sure that this is understood 100%. We don't want any confusion around cash flow, okay? Here it is, right? If you can think about cash flow, similar to like the blood flow in your body, cash flow is the lifeblood of your business. What would happen if your heart stopped or a major artery was severed in your body? You would die, right? Now, if there was an interruption of cash flow in your business, it severely impacts the business's health, and it could kill the business. The same way that if you were to lose enough blood, you would die physically, right? So understanding that, like, we do have it like an idea in our heads about how important cash flow is. A lot of us have a conceptual idea of like cash flow and what the value of it is. You want more cash. You want more cash in the bank. Yeah, absolutely, 100%. And there's a deeper understanding of as to what impacts it. Like, how do you actually improve cash flow distinctly without like having it? You're doing more sales. Yeah, you can actually increase revenue. Yeah, you can cut costs. Yeah, you can take out credit lines. Yeah, it's a lot of people tell you about taking out credit lines to improve business cash flow. But what does that really look like all the way around holistically, so that you can have an approach to your business where you're always flowing with cash inside of it. You always have that business integrity when it comes to cash, so that you don't have the risk of ever having your business be unhealthy or die. Does that make sense? Now, there's some components of cash flow we want to understand so that we can go to work on moving it forward in the right direction always. And in the right direction really looks like, well, my cash flow position improves month after month or year after year, and whatever that's going to look like. And it's intentional. Like, you can do things distinctly to improve your cash flow position always by just understanding the things that impact it throughout the daily operation, and then executing on those things to make sure that you're in integrity to improve the cash flow position, and not just going by and like your gut feeling or emotional feeling about it in the moment, but having the confirmation that this is really something that you want to do to improve your cash flow position, or something that you do not want to do because it will destroy your cash flow position. Does that make sense? So this is going to be fundamental, guys. This is a fundamental conversation. This is the basics. This is a foundation that you want to have inside of business, right? So if you're on this webinar, if you're watching this thing and you've been in business for a while and you have these fundamentals, and it's just like, yeah, this makes a whole lot of sense because it's how I operate. And it's always good to get back to the basics, even if you're at that position. And then here's a reminder for people that get into business and don't apply these principles to the day to day, or at least coming in here periodically to make sure that you're in alignment with these foundational principles when it comes to cash flow, to ensure that that position is going to improve over time. And then we have people that really don't understand this at all, and it's going to really serve you well, because now you can focus on some things to improve the overall cash position of your business in a way you never even thought about before. Okay. So 3 components to this. We have cash flow from operating, cash flow from investing, and cash flow from financing. If I'm looking at cash flow from operating, this is more so in the realm of performance. Income and expenses, profit and loss statement. This is I go out here and I generate income, and then at the end of the day, what did it cost me to generate that income, and then what did it cost me to handle my overhead expenses, and then I have a net profit. So if that's positive, it's a great thing. At the same time, that's not always indicative of how healthy the cash flow is of your business. You could have great profits and poor cash flow. So if we look at operating, this is what it really looks like. There's a bottom line effect. We talk about the net income, right? So you have revenue, cost of revenue, and then you have your gross profit, and you have all your operating costs, your operating expenses. And at the end of the day, you have a net income, net operating income. Okay. So if you're positive on that, it looks good. But then we got to look deeper to see how it's impacting cash. So if your business is doing well, you're generating revenue, right? You're actually doing a profit, and you're like, man, that's fantastic. And now we want to dive in a little deeper to see, well, is my cash flow fantastic as well? There's some things that impact it that we want to understand distinctly. Like when you're doing or providing a service, when you're doing what you do, you go out here and serve your clients, you serve your customers. How are you getting paid for that? Right? What's the strategy for receiving payments? A lot of the times we do net 30s or net 45s or net 7s or whatever that looks like, which basically means that there's an invoice that you create for your clients, and you're not getting paid today for the job you do today. You're getting paid at some future date. Many businesses operate this way. Then there's an impact to that. There's a negative impact to cash from operating that way. So because I do a job, the job is actually going to pay me $10,000 to do it. And if I don't receive that $10,000 today, I receive it in the future. Today, that's a negative impact of $10,000. minus 10 grand. All right. So that's the negative impact to cash. And my profit is good, my revenue is good, but the cash flow is not so good because of that. Hopefully that makes sense. If I look at the flip side of it, let's say I'm buying services or I'm buying something from my vendors in order to do business, like materials or supplies or labor, or whatever that looks like. And with these vendors, I have an arrangement where I say, well, don't necessarily have to pay these guys right now. I can do a net 30, net 45, net 7, or whatever that looks like with them. Right. So that in and of itself is like an inverse situation. It's like of the accounts receivable side. Right. We call this an accounts payable. So because I don't pay today for those services and I pay at a later date, that's actually a positive impact to my cash flow. Okay. So it's kind of a balancing act is what we're looking at here. If I'm providing services, if I'm selling off things and I'm making money today, but don't get paid for it today, it's a negative impact to my cash. At the same time, if I'm paying out for services, but I don't actually take money out of my pocket to pay for services today, I pay at a later date. That's a positive impact to cash flow. All right. So there's an accounts receivable and accounts payable impact to cash flow. Okay. So how do we work this? How do we navigate this in our business with these two concepts? Well, we want to understand, like, well, how can I actually get more money today from what I do? And if I'm not able to do that, like in a way where it's acceptable to the clients I deal with, it just doesn't make sense because the industry standard is that we just invoice and people pay out net 30. Then we want to understand how to navigate the other side of that, or my outflow. What strategies do I have in place to manage the outflow? Things like credit lines. This is also impacting operational cash flow from operating. Credit lines. A lot of people will use this strategy to make sure that they're able to pay all of their supply, like job costs up front, like it's costing me to actually produce the service. So the credit line serves to be able to manage that, right? The job costs up front, pay your people, pay for your supplies, material. And then at the end of the day, you'll be able to pay that off later because you'll get paid in that job in 30 days. So whatever your profit is, whatever that you get, you pay it off, and the credit line, you pay off the credit line, and you have your profit left over. Right. And that really does do well. That ensures that you have a system in place to improve your cash flow operationally if you do have that system going, but you want to understand it first. So what'll happen is a lot of times you'll see small business owners take lines of credit and use it for things like operating costs, like fixed, we call this fixed costs, like things to manage like the business that don't really have anything with producing income for the business. That is not a wise move. Okay. You want to have a strategy in place where if you're taking a credit line, it's directly used to produce the income. This is called good debt, is what we want to use it for. We want to use it for good debt, not bad debt. What I mean is that if I'm taking money, if I'm borrowing money from a credit line and I'm using it to pay regular expenses that don't necessarily pay me anything, like I'm not using it to generate any income, but I'm using it just to sustain operation on the overhead costs. Well, I'm just increasing the amount of overhead costs that I have. Not a smart move. I'm paying the overhead costs anyway that come no matter what, but then I'm adding interest on top of the overhead costs. It's actually costing me more to run that. And that's setting me up for a future disaster. But conversely, if I have relationships with my customers and I know I have good customers who have good credit, they pay their bills on time, and I'm doing jobs for them, well, it makes sense for me to take that credit line and use that credit line to do the job that I said I was going to do, invoice that customer, and then when that customer pays out, I pay that credit line off and have a net positive as a result. That credit line I use made me some money. That's good debt. So this is one way to manage that from operating. Okay. So if I'm not even thinking along these lines, guys, this is the point of the conversation. You want to be thinking along these lines when you're running your business. A lot of times we just go through the day-to-day operations and just do what we need to do without really thinking it through. And because we don't think it through, the impacts of that could be catastrophic, or they could be subtle impacts that drain your energy and vibration and make it feel as though you're not ever getting ahead in life. And it's like, well, no matter what I do, nothing ever works. And it's not that. It's just the fact that you haven't really paid attention to what's going on. And this is the point of the conversation. You want to pay attention to what's going on and then have a real good, effective execution strategy to make sure that your cash is improving month after month. Okay. So I've talked about the first two on this list here. We talked about accounts receivable, which is when I provide a service and I don't get paid now. I get paid later for the service I provide. All right. Negative impact to cash, accounts payable. Positive impact to cash. I buy services, but I don't pay now. And then we talked about credit lines, which is not up here, but it's a good strategy to implement so that we can manage the impact of not getting paid today for the services I provide today. And make sure we don't get that confused with just taking credit lines to pay your regular fixed bills like utilities and overhead costs and such. All you're doing there is increasing your expenses for no reason. Right? I just want to make sure that that's driven home and that makes sense. Okay. Now, the other thing that we take a look at when we're looking at cash flow from operating are things that are really, really great to decrease, a liability for taxes. So it just shows income, like income reduction based on, uh, things like depreciation. So I have an asset that I purchase, and then over time, this expense comes off the books. I don't write it off right away. It's written off over the years that I own this equipment until it has no more usable life. Well, this doesn't have a real impact to cash for operating. It has an impact for cash in another place, but not for operating. This actually that's not said distinctly. It has an impact, but it has a positive impact to cash for operating because it's not a real outlay month after month. For example, I may own a piece of equipment that's worth $100,000 and is going to be usable for 5 years, right? So that's basically $20,000 a year of devaluation or depreciation is what we call that per year. Right. So let's say it's year number 2, and I'm creating this expense for depreciation of $20,000. I didn't actually pay that money out of pocket. It's just the devaluation of the property that I own on the books, and we use that as an expense. Right. So it does decrease my profitability on paper, but it improves my cash really because I'm not really spending that money. So there's a positive impact to that approach to business or that recording of that expense to business. Same thing with amortization. If we have patents or anything like that we actually invest in, they devalue over time. And those expenses are not real outlays of cash over those years that we record those expenses. So it creates a positive impact to our cash, right? And from operating anyway. Then we have things like prepaid expenses that have a negative impact to cash on the outlay. Like we outlay prepaid expenses. At the same time, these things don't record. Like if you're doing what we call an accrual-based accounting system, they don't really record until those expenses are incurred, right? So it might not impact your bottom line yet, but you actually had an outlay of cash, right? But when that expense actually happens, when you incur that expense, you have that expense hit your bottom line, but then, it has a positive impact to cash later on. Now, I realize that some of this stuff is pretty technical to grasp if you're not familiar with these terms, and I don't want you to get overwhelmed with the technicality of how these things impact cash flow. What I do want you to get, though, however, is the concept that the things that you do inside of your operations, what is the tendency of these things to impact, or what is the actual impact of cash on cash inside of the business? So if you look at this a little more closely when you're operating, you can actually steer your business in a way and set up your business in a way to where you're always going to have more cash available later on. in future months rather than less. You can actually improve the amount of cash flow through your business. You can have a healthier, higher performing business in terms of cash. Okay. If you understand like the basic concept of these. All right. So prepaid expenses. Prepaid expenses basically means I'm putting out money here for expenses that I'm not really obligated to pay during this period. Okay. They're future based expenses. So if I do that, that's going to be a negative impact to my cash today. But later on, I'm not just going to record those expenses. My profitability will go down, but my cash flow is actually positively impacted in those periods in the future. Okay. Now, current liabilities. These are things like short-term loans, things that are currently due. We talked about credit lines, right, from operating. This is one of those current liabilities, lines of credit. We talk about how that works. So when we take lines of credit, it improves our cash. When we pay them back, it actually decreases our cash. Okay, but if we're using it in the way that we discussed a few minutes ago, it can be a really great tool to manage your cash flow, right? These credit lines, these short-term liabilities. And then we have things like taxes. All right, taxes will also be something that impact your cash flow. Sometimes it's accrued taxes. You may owe it, and it may hit your bottom line if you're doing an accrual-based system. And you haven't really outlaid any cash for it, but you know that the tax expense is there. And then conversely, if you're in a cash-based system, when you pay this out, it's like it takes money out of your pocket, right? So these are things to consider. Next time, all right? We're not going to get in this conversation today. We're going to start wrapping this up. I'm not going to bombard you with a whole lot of technical finance knowledge. I want you to soak in what we just talked about. I want you to think about the impacts of cash on your operation. And then we're going to come back next time. We're going to talk about investing. Like, what does that really look like for a business? All right. And how does it impact your cash? And when should you invest? First, we want to understand what investing is in the business, and then we want to understand like when it is the right time to invest and how that impacts your cash flow, and how to make sure it's not going to impact you negatively, so that you don't have issues in the future. All right. But with that being said, guys, we're going to go ahead and wrap this up. It's been great being with you. I will see you next week. We're going to get into this financial literacy conversation so that you're set up to win inside of cash flow all the way around. All right, guys, take care. And I'll see you next week.